introduction.
Excellent, thank you. Okay, so this lecture, and it's a little mini lecture, is going to be mainly on financial service product and process, marketing, sales, and distribution. Again, the thesis is that most students, when they walk out with their degrees, they have not been exposed to the sales process. They have not been exposed to the sales dynamics. And you will be selling, no matter if you're a salesperson or not, you will be selling your products and services either internally or externally. So the first is environmental change. So the ability to do an environmental scan and identify the pressures within the environment on the organization will create a organizational, industrial, psychological dissonance. And as that pressure and that dissonance grows due to change, the organization will be forced to change, to reorg and or fail due to myopic natures within its own organization. So the first thing is to understand industrial psychology. The psychology industrially within the organization, within the industry. Organizations are made up of people, individually and in groups. You have to understand the dynamics of individual psychology from a motivational standpoint, but you also have to understand the psychology of groups internally, because groups could lead to groupthink, which means that decisions are being made based on group psychology and not based on best practices or unbiased best practices within the industry and in management science. The dissonance will eventually lead to organizational strength change or a restructuring of the organization itself. Perfect example in the finance industry was Sarbanes-Oxley. First, compliance, CFOs having to sign off on audited financial statements was a big deal, which created organizational change within financial institutions and other corporations. But Dodd-Frank was the major re-regulation that came out after the financial crises, and most of the major commercial banks and investment banks had to restructure their organizations to adopt to the realities of the new regulatory environment. So regulation is a major environmental factor that affects the organizational structure of the firm and creates that dissonance and forces them to change. We're just through competition within the industry. Culture, leadership, and management. To be able to run organizations, you need to have a culture that is usually determined by the leadership within the organizations. If you look at Apple and IBM and Salesforce and other organizations, they have created internal cultures that are exemplified by their leadership as models within the management process. Lastly, strategy, tactics that are being planned and implemented to be able to garner or defend themselves around competitive pressures. So the firm has to be constantly planning and then executing on those plans, either to create a comparative advantage within their industry or to create an environment for survival. And you can look at a lot of companies like Sun, Microsystems, and others that were subjected to severe competitive pressures and eventually failed or contracted into a fraction of the size of their original, at their original peak. The second is the product and process innovation. So through these pressures, through these comparative advantages, firms can then create and innovate product and process that they can sell into the marketplace based on identified wants and needs from the marketplace, either economic wants or needs, or socio-demographic or demographic needs from the population and or the industries themselves within the economy. So to be able to build that product, you need to be able to recognize the needs. I would say, you know, handheld devices and laptops and other technologies are perfect examples of innovative firms that identified needs and wants within the marketplace, innovated, created the product with the product attributes, and was able to deliver those products to the marketplace and then scale. Constant product development process, product modification, to be able to constantly innovating and creating new products and new product attributes to allow the firm to continue to grow revenues over time and create a dominant position within the marketplace. And then lastly, design. Actually, industrial design of the attributes of those products. And again, financial service products, either it be mutual funds or exchange traded funds, or insurance products, or annuity products, or all products with product attributes that basically solve needs within the marketplace for investors and savers. The third level, product and production distribution. Do you have the distribution channels with the right optimal distribution mix within your distribution channels, not only your supply chains, but your distribution channels, to be able to not only create the product, but also distribute the product through your marketing and distribution channels. If you look at JP Morgan, B of A, Wells Fargo, Charles Schwab, TD, you name it, those commercial banks, those investment banks, and those brokerage firms have very large distribution channels. They can invent an ETF, they can invent a mutual fund, and they can distribute that product within 48 hours and raise billions of dollars under management like that. The Schwab and Fidelity and TD and those types of product innovators and distributors, again, can introduce a product and have billions of dollars under management in 48 hours. Good example of not only good product, but also distribution channels that gives them a comparative advantage within the marketplace. And financial services is an extremely and highly competitive environment. Constant battle over market share. The next is the actual sales process, business development, wholesale or retail. Wholesale, I'm a TD Ameritrade or a Fidelity or a Schwab wholesaler. I'm going to go out to the registered investment advisory business. I'm going to go to the individual banks and the advisory practices within the banks, and I am going to market to them the mutual funds and the exchange traded funds and the other trading or asset management platforms to them to see if they will buy our products and services. So first is the business development process, identifying the market, putting together the marketing materials based on segmentation within the marketplace, customizing your marketing and your messages to those market segments, and then go out and market to those target markets, either it be psychographic, demographic, economic, segmentation, and sell in to those market segments to drive revenue growth. Putting together clear communications and advertising campaigns with a portfolio of advertising campaigns with different returns and different penetration rates. Identifying prospects and clients, but converting those prospects into clients that then they end up buying your product and or holding their assets on your platform so that your company is basically making fees off of the sales of the products, but also making fees by offering service platforms and also making fees based on assets under management. Those are the three core revenue streams for financial services firms. So again, the key is, do you understand the sales cycle to identify prospects within the marketplace and convert those prospects to clients? Once you have the clients in your hand and you've locked them in, you are basically looking at a perpetual revenue stream if you can conduct the client and the customer service. The client and customer service is the opportunity to then go through the cycle again to touch the clients on an ongoing basis to be able to upsell them higher quality, higher margin product, cross-sell them other products and services within your suite of offerings, and to be able to lock them in as permanent clients going forward. That then creates a perpetual stream of revenue for the corporation, and you as the salesperson or the investment manager. So to get into some of the technical aspects, and this might be a review for some of you, but I think the model here is probably, these are two of the most important models. One's a technology model, the other one's a product adoption model. Both models, when you are hired by firms, you will probably be working in a group or with a marketing group that will be introducing a new product and service, and you will have to assess that product and service based on its technology cycle and attributes, but also the adoption cycle of the products with their attributes over time, because you're going to have to be able to forecast revenue growth. Is this product, is this process, is this campaign going to pay off at the end of the day? Is the company going to put up the R&D dollars to be able to fund the campaign, fund the product development, sunk cost, and are the revenue streams that are going to come off of those products going to give us a net positive present value in the end? And I'll go through that in a second. So the first two models, the first one is the S-curves. And you might have been exposed to the S-curves in your operations research. It's basically the development of technologies. Technologies have life cycles. They run in S-curves. So you have your sunk costs, and then the technologies and the revenues and the productivity from those technologies increase at an increasing or an exponential rate, and then the technology then runs its course, deteriorates, becomes obsolete, and goes into decline. Companies like Apple and IBM and others will have multiple technologies, or there will be technology cycles over time. As you know, it was what early cell phones, and then cell phones with cameras, and then cloud computing or server technologies, parallel computing, then cloud computing. So you can see the technology curves that are being created over time. So the question then becomes, do you understand these technology curves that are successive and contiguous over time? Are you utilizing those technologies as they're being developed and brought into the marketplace to be able to generate continuous and ongoing revenue growth? And as you can see, the idea is to be able to identify and to develop successive S-curves so that you're developing and innovating technologies continuously over time. The other theory, which is less technology-based but more marketing-based, is the product adoption cycle. Now, products, either it be technology or financial services, go through the same adoption cycle. That's why you hear when Google introduces the Google Glass or Apple introduces the Apple Watch. The question is, how has it been adopted? Has the adoption of those products exceeded or have not exceeded or met expectations by the management and the marketing team. So when products are first introduced, it's usually the innovators and the early adopters that will adopt the product. And usually that innovator and the early adoption stage is usually flat for quite some time. So you're sinking and you've sunk a lot of money and a lot of opportunity cost into not only developing the product, but getting it adopted. And there are certain hurdles that you need to meet before the product will be fully adopted. Does it create utility? Do you need it? Do you want it? Does it create value? What is its attributes? All of those factors. Is it priced right? Based on the price, are you getting more utility than the actual price of the product? Because usually the products are very expensive in here because of large fixed costs that need to be allocated across a small batch of production. But if the product takes hold, i.e. exchange traded funds, mutual funds, iPhone, iPad are good examples of adoption, you then move into the early majority adoption phase. Early majority, so you go from innovator into early majority adoption. Early majority adoption is when the product is being adopted on a large scale, very rapidly, exponentially. And that's why you look at these technology companies and ask, why are the multiples so high for a lot of these companies that have no revenue or have not, had a profitable quarter yet? Is because the technology itself allows for scalability across millions of users within the economic, global, or demographic global sphere. So you start to scale. This is the early majority phase. Then the product reaches some majority, so it's still increasing at a decreasing rate. And then at some point, everybody has fully adopted, and only the laggards that have held off the longest enter the marketplace, enter and adopt the product. So just like the succession in the series of S-curves in technologies, the motivation for the firm is to create new product with new hawthorn and adoption cycles, and be able to create a succession of new products and new adoption cycles to be able to grow revenue at very high rates continuously over time. Why do you think Google and Apple market cap is so large? Because they have huge market penetration, they introduce new products, different versions of the iPhone, and it creates massive Hawthorne effects and creates new product adoption cycles. And when they introduce new products, again, it creates this product adoption cycle. So you will probably at some point in time be asked to work on a team to introduce a new product and service, and you will go back and you will look at prior products and services that have been adopted within a similar environment, in a similar industry, at similar time periods, and you will project your revenue streams based on the introduction of those new products. And if you know that you can capture, if you know what the industry is, if this is the iPhone market, right, the handheld market, and we know that Apple captures 50% of the market, and we know what the adoption cycles look like, I can forecast, we can forecast free cash flow from those projections and be able to calculate the present value, net present value, and internal rate of return of introducing those products. Obviously, your R&D team and your acquisitions team will be looking at developing new products based on cost, or acquiring new firms and new technologies based on cost. That's going to be your sunk costs, your negative arrow. Then you're going to use these S-curves and these product adoption cycles to project the revenues and the free cash flows from either those firms or those products. With those two, you will be able to calculate the present value of that company or that entity or that product, the internal rate of return, the break-even, and potential real option contracts that may be embedded either in the companies or in that intellectual property. And then lastly, to be able to identify any barriers to entry on the entrance into those markets, but also what is your exit strategy? How are you going to exit? What are the metrics that you are going to have in place to be able to make the decision, we are going to discontinue the Google Glass. We are going to discontinue the Apple Watch. What are the metrics that you have to have in place to be able to make those decisions, to be able to exit the marketplace? Or we have been working over the last 20, 30 years to build a technology company. We've built product, we've acquired companies. We are now at a point where the technology company is so big that now what we can do is either divest certain portions of it or go initial public offering and take it public. What is the exit? Either entrance and exit strategies, the ability of the firm to make decisive decisions, management team to be able to execute, and then lastly, rules-based entrance and exit rules so that the management team and the individual leaders can make decisions that are unemotional. I'm not tied to a certain company, I am not tied to a certain product. If it doesn't make economic sense, let's cut our losses and move on. Firms usually make really bad decisions. They acquire the wrong firms, they pay too much, they sink too much money into products that will never be feasible, and they don't know when to get out when getting out is good. So if you can hit that for me. Thank you.